Everyone in America has heard the same investing advice. Just buy VOO, keep investing, and hold it for the long term. And honestly, VOO is an excellent core ETF. But here's the part most investors never hear. Over the last decade, one specialized ETF delivered more than double VOO's annualized return. We're not talking about crypto, a single stock, or some risky investment nobody has heard of. We're talking about a publicly traded ETF that averaged more than 34% per year over a 10-year period. But there's a reason most investors still shouldn't make it their entire portfolio. That ETF is SMH, the VanEck Semiconductor ETF. Instead of owning hundreds of companies across the entire US economy, SMH focuses heavily on the semiconductor industry, the companies responsible for producing the chips powering AI, cloud computing, smartphones, electric vehicles, data centers, and modern defense systems. Its holdings include major names such as NVIDIA, Broadcom, Taiwan Semiconductor, and ASML. And historically, this concentration has been incredibly powerful. SMH delivered roughly 34% annualized returns over the last decade, while VOO was closer to 15% annually. Now imagine investing $10,000 and achieving those historical rates over 10 years. The difference becomes enormous because of compounding. But here's where the story changes. SMH doesn't produce those returns for free. Semiconductor stocks can be extremely volatile, and when the technology sector gets hit, SMH can fall dramatically. During the 2022 bear market, it dropped more than 33%. That means an investor who bought SMH near a peak could have watched a huge portion of their portfolio disappear temporarily. And this is the important lesson. The ETF with the highest historical return isn't automatically the best ETF for you. VOO gives you broad exposure to 500 major US companies. SMH gives you concentrated exposure to one powerful industry. One is designed for broad diversification, the other is designed to capture a specific growth opportunity. So, ask yourself one question. If your ETF dropped 30% or 40% during the next market crash, would you keep buying or would you panic and sell? Because your answer may matter more than the ETF's historical return. If you want more simple breakdowns of the ETFs, American investors are watching for long-term wealth building. Subscribe and comment below VOO, QQQM, VGT, or SMH. Which one would you choose for the next 10 years?